Hello, and welcome to Wealth is Possible, the show where we talk about personal finance and building wealth. We are your hosts, Vino, Vince, and Evan. We'll be discussing various methods of building wealth and growing your cash flow, including the stock market, real estate, cryptocurrency, and various business ventures.
Damn, son, where'd you find this?
This guy sounds like Grant Cardone.
Yeah. What are you saying, bro?
Not much. Just glad to be back. Glad to continue providing this value and sharing our knowledge, right?
This guy's the infamous knowledge beard of knowledge. You know, we love Vino.
There's money trees and there's beard of knowledge.
Yeah.
All right, so we ended off last episode with I think the camera died, but we ended off last episode talking about market cap and
yes,
and just a intro into the stock market and the different types of stocks.
Yep.
Today we're gonna be talking about risk tolerance and long-term investing, and let's get right into it.
Risk tolerance and long-term investing. Let's do this.
So the number one thing you should do before you invest is understand your own risk tolerance. You know what I mean?
Yep. And everyone's gonna be different when it comes to risk tolerance.
I don't think any of us even thought about that when we were
investing.
Yeah.
I didn't. Yeah,
well, I kind of.
Did you think about it?
A little bit.
I mean, I just knew that like whatever I put in, I knew not to expect too much, or anything can kind of happen, right? I knew that much, right?
I think like a lot of things that we have invested in so far, I think we've had so many collective wins that I think we haven't really experienced a true loss yet. Like especially like in the markets, right? So like I guess like that can long term that could fuck
I mean we've been humbled a little bit. I think we've been humbled a little bit.
But
you need to be humbled in everything.
You do.
Otherwise you don't learn, and we wouldn't know what we know now if we weren't humbled a little bit. I mean,
so during those losses, if you were comfortable with those losses, then I guess that's your risk tolerance.
Yeah, and I mean your little foreshadowing into the next segment, the long-term investing segment. But yeah, so anyway, so I'm not gonna go too much into risk tolerance because there's a great video on YouTube. But
we should make a video.
A gentleman
on risk tolerance.
Yeah. We should.
If you guys want us to make a video on risk tolerance, make sure you guys comment that down below, and while you're at it, like the video as well.
Yeah, but in the meantime, there's a gentleman by the name of Steve Antonioni on YouTube, and his video is just perfect. It's like the only video on YouTube about risk tolerance when it comes to the stock market.
Were you talking about him when you said there's a sick guy online?
Yep.
Okay.
It's obviously going to be linked in the YouTube description below.
We'll put his links all down below. Yeah.
And this I was just watching this video, right, just in preparation for this segment, and I was like, okay, there's no point in me even bothering because this guy just says it perfectly, and I'd rather just people just watch that. Right. But, essentially, the two main factors when determining your risk tolerance, number one is your time horizon. Number two is the stability of your income. Right.
Yeah.
So everybody's time horizon is self-explanatory, but, let's just explain it anyways. It's how long are you OK with leaving your money in the market when you need it?
When do you expect to, need to pull that out? Right.
Exactly. Yeah,
and shit happens too. So sometimes you might even have to.
You might be putting money that you're saving for a vacation, or you're saving for your marriage or wedding or ring, whatever. Right.
And that is and I've learned that firsthand. Like, if you're expecting to pull out your money on X date, that is not a strategy for success.
It's not. You can't. You literally. There's a common saying. You literally can't time the market.
Exactly. So if you have a 1 year time, for example, you could have your time horizon could be 1 year. It could be 3 years. It could be 5 years. It could be 10 years. It could be 20 years. No, but like your time horizon is different for everybody, right? So like if it's basically how long you're willing to wait for your returns, right?
Yeah.
So I would say like anything under a year is a little bit risky.
It's really risky, but you could pull out, and it could be a bear market, and the market could just sell off. Even if it's the best stock in the world.
But like what if it's like obviously like we're not engaged in any of that right now, but like down the road, like if we were to be like home flipping, for example.
Yeah.
Right, for home flipping, you can kind of time when you're going to be pulling out the money, because like if it's going to take 3 to 6 months for a renovation,
Yeah.
you can kind of be like, okay, I'm putting this money in right now. Within 3 to 6 months, I'm going to be able to cash it out. Right, so like that's why I was like, I don't know if we were speaking about a specific, like
We're speaking about
the stock.
just directly, stock market.
We're speaking about very high level, like just for the broad, like average person that's venturing into the stock market or doesn't even know, because a lot of people, how they get into the stock market, like we talked about in the last episode, is someone tells them about a stock and they buy it. It goes up and then they're like, oh shit, this is fun. Right?
I mean, that I'm sure that's most people's beginning.
You know what I'm saying? So and that's not really the truth of it.
Exactly.
It's you got lucky. Congratulations.
Right?
You can keep trying it over and over again. You're gonna get
the right
burned.
place at the right time, pretty much.
Exactly. Right? Basically, you got to determine what your time horizon is before you invest, because if your time horizon is really, really long and your age, you say you're really young, you can afford to invest in high growth tech stocks kind of thing, versus if your time horizon is like a couple of years and you want your capital to be preserved more, you could put your money into an ETF such as VOO or VFV in Canada, which tracks the S&P 500. And you can sleep well at night. You don't have to pick individual stocks. You don't have to worry about, the CEO decided not to go into work today and now the company is went under and shit, right? Like
it'll be less volatile.
Exactly. And like
So
it'll be up and down. Like for example, like
it would be like smaller.
like the S&P 500, like it had that little sell off at the when the COVID happened.
A little correction.
Like what was it? I can't say COVID, right? You can't do that.
Yeah, we gotta,
Okay.
I'm gonna put the for that. Yeah.
If you look at the VOO chart and then the VFV chart, you can see that there's a little cliff. It fell off a cliff and then it recovered and went to all-time highs. Right? We just finished going over Steve's video on risk tolerance.
Yeah, you guys can check that out. Press that box you see over there.
Yeah. So I just want to just reiterate a couple things. Typically, someone who is comfortable with higher risk stocks has a little bit more time, has a longer time horizon, as Steve was talking about in the video. 20 years, 30 years. Tech stocks, high growth stocks that obviously you do your own due diligence on and you research, and they actually happen to be sound investments. You would look to invest in them for higher returns. However, if you're more risk averse and you have a shorter time horizon and if you don't want to take on as much risk, or if you have, for example, like the example that Steve gave where you want to get to $1 million by 50 years old.
Yeah.
You have $200,000 today. You do the calculation. You just need a 7% return each year for 24 years to get to $1 million. Nothing crazy. And in that case, if you want a 7% return, you can invest in VOO or VFV. So VOO is the American version that tracks the S&P 500, the index fund, and the S&P 500, as we went over last episode, is the best companies essentially in the world. It's a basket of them. So for example, some of those companies include Apple, Microsoft, Amazon, Alphabet, which is the parent company of Google, Facebook or Meta, whatever you want to call it, Tesla, Berkshire Hathaway, Nvidia or Nvidia, I don't know how you say it, JP Morgan Chase, Johnson & Johnson, to just name a few. The Canadian version is called VFV. You would look into that. We're not
financial advisors, by the way. So if you guys are,
we do your own due diligence. So look into that one if you're in Canada, because, which most people I'm sure listening are, you won't have to pay the exchange rate. It's the Canadian version of the index fund. And let me just pull up really quickly here the chart.
Yep.
It is up 28% since last year.
Damn.
So
that's more than the low interest savings account they offer us. What is it? The
Lisa, right?
The Lisa, yeah.
In the last 5 years, it is up 100%.
Damn.
And you can see most of these index funds, everyone had that dip here. You can see in March of 2020, it just fell off a cliff, and then it's back to all-time highs.
Yeah.
Right? So this, the VFV, let me just pull this up here.
If you guys are watching this on, if you guys are listening to this on Spotify or Apple
podcast, head over to the YouTube channel.
Yeah.
You can see the chart on the screen. We'll just put it up on the screen for you, the screenshot. You can see this. I believe it began in 2013.
Yeah.
At approximately $24, somewhere around there.
Beautiful.
2013, it was $24, and currently it is $105.
Okay.
Adjusted to inflation as well.
Adjusted to inflation. So that is a return of
It's
a lot.
about 5x, right?
Yeah, about a 5x. About
Yeah.
a cool, what, a 600% return.
Mm-hmm.
Not bad, right?
Mm-hmm.
Not bad to, this is the Canadian version of the ETF.
Yeah.
So
Canada.
Canada.
Yeah, Canada.
Oh, Canada.
Oh, Canada.
Just look into, I would just say to look into VFV.to, which is the Vanguard S&P 500 Index ETF for Canadians, and VOO is the same one for the United States. It is at a higher share price, I believe, because of the outstanding shares.
And if
Correct
you guys
me
didn't-
if I'm wrong in the comments below.
Yes. And if you guys didn't hear that the first time, we are not financial advisors. Awesome.
Okay.
Yeah.
So let's dive into long-term investing now.
Long-term investing, right?
Mm-hmm.
So a great quote
Yeah.
of how, I like to look at it, how Warren Buffett described investing. So investing is giving up a certain amount of buying power today in order to have more buying power in the future.
Mm-hmm.
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 In other words, trying to beat inflation,
Yes.
right? That's kind of the goal, right?
Mm-hmm.
Trying to get a return and beat inflation.
Mm-hmm.
Yeah. And have your money work for you.
Exactly.
Mm-hmm.
That's what we want at the end of the day, right?
Yeah.
We want to build our capital to a point where we can get a yield from that capital and that pays us every month passively,
Mm-hmm.
right?
Mm-hmm. Mm-hmm.
So a key thing that always comes up, since people have been asking me about stocks the last little while is, hey, why is the business doing so great, putting up great news, and the stocks tanked,
Mm-hmm.
And the simple answer for that is the business or the company is not the stock price. They're not the same thing.
Mm-hmm.
Mm-hmm.
A prime
The stock
example.
price won't always reflect exactly
The
what
company's
that
performance,
company
yeah.
is
Exactly.
gonna
And
do.
there's a reason for that, right?
Mhm.
The reason for that is, and I'll give a prime example. I don't know if any of you have heard of the company called Amazon,
Mhm.
right?
I think I heard of it,
There's
yeah.
a little company called
Small one,
Amazon,
Yeah, I
right?
think I've seen a
So-
building that's an Amazon.
Yeah.
Yeah. So back in 1999, it was trading at a share price of $113 US,
Mm-hmm.
right?
Mhm.
2 years later, 2001, all of a sudden it's trading at $5.51. Mind you, in 1999, the revenue was $1.64 billion
Already, eh? Back
in
then.
1999.
Wow.
So I believe they
And he's
started in
driving
97.
I
They
remember
started in
he-
97, I believe.
He's driving an old Accord around that time, too.
Jeez.
That guy's crazy, bro.
Yeah. And that's revenue. He's not taking that money out though,
Yeah,
right?
yeah.
So
Mhm.
Of course.
and they weren't profitable in the beginning either. So I think they were at a loss of 700 million in like 99,
Yeah.
I believe.
Okay.
In 2001, when the stock price went down 90%. So imagine you invested at $100. 2 years later, you lost 90% of your money. Meanwhile, Amazon doubled their revenue to $3 billion
Wow.
in those 2 years, and yet the stock
Mhm.
went down 90%.
Mm.
There's this famous video on YouTube. You can check it out. Jeff Bezos saying, "The stock is not the business."
Mhm.
We should watch that video too, but not right now.
Yeah, yeah. We're gonna end up watching a lot of videos on this on this podcast. So and then keep in mind, in 2009, the stock price still hadn't recovered back to $113.
Mm-hmm.
2009. So that's 10 years later.
Yeah.
It was $47, and the revenue went up 24 times to $24 billion.
Jeez.
Wow.
And it still didn't go back up to $113, which was the high.
Tells you a lot about just generally investing,
yeah.
how the journey can be, right?
It's a long and it's a cold world.
Yeah.
You know? If you want those gains,
Yeah,
you
yeah.
got to stomach the ups
You
and
gotta
downs.
stomach it,
to stomach it.
Otherwise, there are, as we mentioned, the VOO, the VFVs,
Yeah.
where those are actively managed.
You know another thing about just like knowing like the fundamentals of like just like assessing a stock. I think it gives you like a huge peace of mind.
Gives
Right?
that
'Cause, like,
confidence and
Yeah, because like imagine we were using an example of $100, right? So imagine we drop like a lot more. Imagine you drop like $100,000, and you lost 90% of that. I'd be like, yo, fuck, bro. Like you know, like I'd be tripping, right? Like if I didn't know anything about the stock.
Exactly, and you were told, hey, like this is a great company, it's gonna be huge.
Yeah. And
like,
everyone
this
around
company's
you
only been going up. You know, it started at $10. It's only been going up, and you know everybody around you got in earlier.
But everyone around you is like, yo, bro, just sell it, bro. Like, Amazon's a scam. You know, sell that shit ASAP, bro. I got out of it. I lost like 20 grand, but it's okay, man.
And that goes back to the fact that, you know, a lot of people, and even now, even today,
with all the information,
with all the information, and you know, all the TikTokers and whatnot. You know, I mean, I think that's part of the problem. But but like, you know, all the information that we have, people still have the same mindset that they had way back like 10, 15 years ago, where it's, you know, they get into the stock market and it doesn't do what they thought it was going to do. And they sell for a loss and they never go back in and they're traumatized. You know what I'm saying?
Yeah.
And they're like, yo, stock market is a scam.
Yeah, exactly. You know what?
Fuck the stock market.
I think those people never came across Steve's risk tolerance video.
Most likely.
Fucking Steve, we gotta push your video more, man. Come on, buddy.
Help his algorithm out.
You know,
Hashtag algorithm.
you know, it's just, you know, you're just, you know, a lot of people just kind of look at it as like it's a casino, right?
Yeah.
It is what it is. That's facts. You know what I mean? Like,
it can be, but it also can be.
It can be. But if you're gonna think of it as a casino, you're also gonna lose like the casino.
Exactly, 100%.
Yeah.
Right. And then another thing I want to add is, you know, like manipulation or shorting stock.
That's another factor,
that's
right?
always gonna be there, and you know, there's two sides to every coin, right?
Yeah.
And you know, you can look at it as it's actually a necessary thing that needs to actually always be there, because shorting needs to exist, because there are companies that go up so high and get promoted so well that retail investors that don't know any better get into those companies, and then the people who promoted the stocks literally just dump all their shares, and they lose a lot of money. So for that reason, in that scenario, someone who's shorting that stock, a hedge fund or somebody who's shorting that stock, is actually the good guy in that scenario, right?
You come off as the bad guy initially, but then you're
exactly
doing
so in that scenario, shorting is actually like a necessary evil or whatever you want to call it.
But generally,
the manipulation is always going to exist. Every single stock has a short position against it at any point in time, especially if it's a legitimate, like, quality stock, because hedge funds are called hedge funds because they have a long position and then they have a short position to hedge their long position.
And you got to take all that into account when you're getting into the markets, and you got to know that all this is happening, right?
Yeah. So just because you saw GameStop go up like 5 million% doesn't mean every stock's gonna do that. You know what I mean? We want to compare, you know, short-term gains to long-term gains, right? Short-term gains are cool. You know, you get in, you get lucky.
You get an instant rush. You know?
Yeah, you get in, you get lucky. You think you're, you know, Wolf of Wall Street. You get out, right? So for example, right? Let's just go to the example. So, if you say you bought Amazon in 2003 at $18 per share, right? I don't know. Let's just say you put in like what, $1,000.
Yeah. Okay.
1,000. No, 1,000. You bought 1,000 shares, $18.
1,000 shares. Yeah, that's easier to calculate.
Okay. And you put in so that's 18 grand.
18 grand.
And in the same year, you sell it at the high, $61. That's actually pretty good. Like, you know, making even 20% is a huge deal.
Yeah. And
right?
300%. Yeah. Short term, it's
crazy,
not bad
right?
at all.
So you sell, right? And then just say like in another hypothetical scenario, you didn't sell. And you actually, you know, you did your research on the company. Your time horizon was much further out. You have a 10-year time horizon. You're willing to wait until you're able to wait. You're willing and able to wait until 2013.
You were not only willing and able to wait, you had that conviction and you believed Amazon was a long-term play. So you waited. And then...
And in 2013, if you were to sell Amazon, instead of you selling it at $61, you would have sold it at $405.
Wow. So that's $405,000 if you had 1,000 shares.
Yeah, which is a 2,250% gain, or 22 times your money.
Wow.
In 10 years.
In 10 years. Right?
It's not bad, right?
It's not bad.
You
It's
guys,
not bad,
you guys
so
want to make 22 times your money?
I would love that.
I would love that. Yeah.
Oh, yeah.
I would love that.
Right?
And
then
I mean,
let's-
not every company grows like Amazon, but this is just.
But yo, if
just to
Amazon
show
did
you
it, then
guys.
I'm pretty sure there's a lot of other companies that are replicating that business model that it can probably do it as well.
Yeah,
right?
Amazon is like one of the it all goes back to the head of the house, the CEO.
Yes.
How they run it all comes back to them. If the CEO is great, visionary, they're disciplined. If the founder, the initial founder, stays on is still the CEO, like that is kind of a good sign for a company. A lot of the times the founder leaves like for early startups, and then it's just a new
somebody else
person
that-
replaces it, and
Yeah.
it goes to shit.
Yeah.
You know what I'm saying? But Jeff Bezos is still at the helm, right?
Yeah.
I think he stepped down, but he's still kind of in there. I don't know.
I'm not 100% sure.
I'm not too sure if he stepped down.
Yeah, I'm not
I think that
100%
was.
sure about that. I know Bill Gates stepped down recently from
Of course,
Microsoft.
yeah.
I'd imagine.
What,
But,
2020.
We're not gonna get into that.
Yeah.
So again, we did the 10-year example, but say what if you were to have bought Amazon at $18 and held it until today, present day.
Okay, now what's the price?
So it's I believe 3,700 was the high in 2020. 205 times your money.
Yeah.
Wow.
Okay, wow.
So it's 205,000% gain or something.
205,000%.
so I believe-
Sounds like crypto.
Yeah, that's a crypto
yeah,
number.
so a lot of
Yeah.
the people that are in crypto, they're like, oh, I made that last week, right?
Yeah.
But the difference here is,
Altcoin.
the difference here is you were able to sleep well at night knowing that
Yeah,
this business
yeah,
is
yeah,
performing,
exactly.
and you're not like, oh no, Shiba's gonna go down
Yes.
tomorrow.
Yeah.
You're not like
It's
crossing
not
your
built on a
fingers.
meme.
Yeah.
Let's just say that.
Yeah, we mentioned in the last episode the
Yeah.
book Psychology of Money.
Mm-hmm.
A lot of this is stuff I've learned from that book.
Mm-hmm.
We're gonna put a link to that down below. for you
100%.
guys.
Yeah, you guys have probably already seen the link if you watched the last episode, but there's a link
We'll
again.
put it there
just in
again.
case.
Yeah, I got you guys.
Just in case you forgot to buy the book.
Yeah.
But the main thing is, long-term gains come with a price, right? Just like everything, there's a price for everything, right? But the price of long-term gains is not actually your money.
Mm-hmm.
You're not paying in dollars. What you're paying for it in is volatility, fear, doubt, uncertainty, and regret. Just, I read that,
You're
and
paying for it with your sweat, right? I mean, you gotta be able to.
Sweat equity.
You gotta hold it down, right?
100%.
Yeah,
And it is not easy. Well, I think we've all experienced it now. Like
Yeah,
I experienced it, and
I've experienced
you
it.
guys were
Oh,
in some
yeah.
of the positions that I'm in, and like it goes down, and it's like it makes no sense at all.
Why?
And
right?
if you were to sell, you would have lost a good chunk of your
Yeah,
money.
Yeah. But
And-
that's why I'm glad. I learned to look and get all that information and build the conviction before really even getting in.
Yeah.
Right? Mhm.
But if anything, it's if all the numbers make sense, it's a buying opportunity. When it's down.
100%.
Yeah.
Not a financial recommendation.
Yeah. It's
but,
not a financial recommendation. Like I said, I don't know if you guys didn't book it the first time, but I said that I'm not a financial advisor.
Well, yeah,
So-
but
So
in
make sure,
principle, like if you do your own research and
Yeah.
we're gonna be touching on that in the next stock market episode, next edition of this series here about how to decide whether or not a stock is a buy or
Yeah.
not.
We're going over the checklist, right?
the checklist
Yeah,
of Mr.
yeah.
Brian Feroldi.
Yeah.
We'll put his
That's very
channel in
helpful
the
for sure.
description as well.
Yeah.
A lot of people, they do research when they're furnishing their home. They're buying a car. They do a lot of research, right?
yeah.
You don't want to buy ugly furniture,
Oh yeah. And you don't want to buy
an ugly car
an
or,
ugly car
or
shitty
a
car, yeah.
lemon, right?
Yeah, a lemon. Yeah.
Or we're not gonna name specific brands of cars, but you know what I'm saying. You don't want to purchase one of those vehicles
Yeah.
without
Doing your research.
Yeah, questioning people on
Watching
people
a few
who owned it,
reviews,
watching
maybe,
reviews, right?
Mhm.
And how much is furniture really? How much does furniture pay you throughout the course of your life?
I think it pays my
keeps
ass
you
some
keeps
good
you a little
support,
comfy, but
besides that, yeah.
other than that, not much, right?
Yeah, exactly.
Yeah, and then your car. I mean,
Unless you're
car,
renting it out, unless
I
you
mean-
have like it's okay.
again, as he said, renting out furniture. As we said in the first episode, there's a million ways to make money, right?
Yeah. Oh yeah, that's another way you can rent
Yeah,
out your
yeah.
furniture.
I mean, technically, you can.
Many things. There's many things
you
that
can use that
rent
for
out.
like a staging company.
Yeah,
Get top dollar.
100%.
If you guys want to learn how to get more top dollar for your listing, contact me.
Shameless plug, right?
Shameless plug, yeah.
A car. How much does a car pay you every month?
I mean,
It depends.
Unless
If
you
you
have
have it
it
on
on
Turo,
Turo,
if you have it on
again,
Turo,
yeah, if it's not on Turo, then it's not really paying.
Or
you,
doing
but-
Uber, Lyft, or
Yeah.
all right, I guess there's some incentive there. I guess.
Shit, man, this is never ending.
Yeah, it's, the rabbit hole doesn't end, right?
But just on average.
On
most people-
average, yeah.
if your car is just sitting in your driveway, how much does it pay you?
It's actually
Nothing.
taking from you.
Oh,
Yeah.
okay, yeah. And it's crazy how people they do research for about for that, but they don't actually do research when they put their money
When they're
into the
actually
stock
investing.
market.
Mhm.
When they're
That could
investing,
actually
yeah,
pay
yeah,
you
yeah.
Yes.
Makes sense, makes
for the rest of your
and
life.
and give you life changing gains, right? So
Yeah,
But but then it'll be too easy, right?
mm,
yeah.
Then it'll be too easy.
That-
Life will be too easy at that
That's
point.
why I guess that's why financial advisors exist,
mhm.
Yeah.
because
Mhm.
They give you an average 6% return, I think. Right?
minus the management fee, right?
Oh, snap. Okay, so I guess
You got to take off like a couple percent.
I guess it's
You
a
get
little
4. You end up with 4
bit
probably.
4. Yeah.
Mm.
So, okay.
So it matches inflation.
4 times what you get from a Lisa.
Yeah.
Low interest savings account for those of you that
By the way.
he's catching up on. Yeah, yeah.
Yeah, you got to look at the stock market as similar to, for example, going to Disneyland, right? Say
Yeah.
it costs you $100 to go to Disneyland, right?
Mm-hmm.
A lot of people will go to Disneyland and pay the $100 even if it's raining. And they got it.
Yeah.
You know what I mean? Like
Yeah.
Mm-hmm.
they pay the $100. They're already inside. They're gonna enjoy themselves, right? Sometimes it rains,
Yeah.
Mhm. Mhm.
right? The stock market is similar.
Mm-hmm.
You just can't buy a stock and expect to have like it be all rainbows and sunshine.
Yeah.
And the stock just goes up and never corrects and
yeah.
never like behaves like spontaneously.
If you look at any stock chart, I guarantee you it's gonna be up and down, up and down, up and down.
Yeah.
There's you don't see anything else,
Mm-hmm.
right? So
100%.
when you buy it, you gotta expect it to go down. It's gonna go down.
$100 to go to Disneyland, it might seem like a steep price, but people are willing to pay it, even if it rains, because of the quality of their experience and the return they are getting for their money. Even if you make like 40% return in a year, you would be willing to stomach the volatility.
Mm-hmm.
40%, right?
Mm-hmm.
Like 10% is like average.
Mm.
8
Yeah,
to
yeah,
10%
yeah,
is average.
Yeah. Yeah.
40%, I'm sure people are willing to stomach the volatility, right?
Mm-hmm. Yeah.
So another analogy I like to look at is if you get into the market and you make big gains on a stock or crypto or anything, and then you get out and you're like, yes, I made money. This is crazy. Like this stuff is easy. I can do it. That's not the stock market. Like you just got lucky.
Yeah.
Right. It's similar to not wanting to pay for a car. You basically want to hotwire the car and you want to just drive it for free.
Yeah.
And eventually you're gonna get caught.
Mm-hmm.
Eventually the market will humble you.
The market will count. Yeah.
You know what I'm saying?
Mm-hmm.
You don't want to do it without paying the fee. When you pass go, you got to pay the fee. Actually, that's not how it works. You collect money, right? In Monopoly. But like, you know what I mean, right? There's a price to pay, and you can't just expect to get the gains without basically paying the fee.
Yeah. Yeah.
Essentially,
At least you
it's
can't
not a
expect
monetary fee. It's an unrealized loss that you may see on your portfolio.
Yeah.
But you're not actually paying any money. I mean,
Yeah.
aside from the commissions and whatever, but there's Wealthsimple, stuff like that, whatever. But like, you're not actually paying a fee. It's literally the price you are paying is your time spent researching the stocks, and your time spent learning to be a good investor, a sound investor, using things like Brian Feroldi's checklist, consuming content like Steve's videos, etc., etc. All that time you spent, like we talked about last episode, I think we talked about it, like people spend so much time studying in their undergrad for their midterms and their final exams, right?
4 years,
Imagine you spent
5
a
years.
fraction of that time learning about how to be a sound investor, which will pay you for the rest of your life,
Exactly.
right? Rather than being lazy and just taking somebody's word for buying a stock,
Or
literally
watching
having
one,
no
two
idea,
YouTube videos.
and just being like, oh, the chart's going up, I'm gonna make money, right? That's a recipe for disaster, right? I mean, we've all been there. We talked about it, right?
Yeah.
But the car analogy is a good one, right?
Yeah, it's really good. It's really good. And I think, I don't know, I'm just going to clarify to most people. It's like we have two types of gains. We have realized gains and we have unrealized gains, right? So when you buy into the stock and you see that your portfolio is lower than it should be, you're like Vince said, you're not paying, you didn't actually lose that like you didn't lose the money.
Mm-hmm.
If you hold on to it, you only lost
it
sell.
if you sell it. Yeah. Then you realize that gain.
Then you realized that gain
or loss, right?
Yeah.
Mm-hmm.
The stock price isn't actually real, it's just a figment of your imagination. But like, you know what I mean? Like it doesn't match. It's not matching the business. It doesn't necessarily mean the business is doing poorly or anything like that.
Yeah.
Mm-hmm.
It's just kind of like a deterrent, because otherwise, if it was that easy, then everybody would be rich, right?
Yeah.
Yeah.
But
nobody would work.
There's nothing I want to throw in there too.
Mm-hmm.
When you see your stocks at significantly way higher too,
mm-hmm.
and even when you don't sell, then if it's still unrealized, you still didn't make the money yet.
Mm-hmm. You would have to pull the trigger and sell.
Exactly, right? Because like, you can be like, okay, cool, I have $100,000 in here, I can just pull it out, whatever. Going back to that timing the market thing,
Mm-hmm.
And that's a great point that you bring up, because that's something else I wanted to touch on is if you've already made, say in a short amount of time, you've already made like 50, 100% gains or 20% gains, don't just and you know nothing about, you don't know nearly enough about that stock long term, and your time horizon is not that long. You want to take some profits off the top.
yeah.
And I learned that firsthand. Like, you want to take some profits off the top, because that could go down 80% tomorrow, or like 50% tomorrow. We already talked about Amazon going down 90%. A company like Amazon going down 90%.
That's crazy.
Back in the day.
That's crazy.
I mean, that's back in the day. Now,
and like going back to that, it's very, very normal for you to be like, okay, this is the end of the world, right? Because people don't know. Most people don't even know that stocks have fundamentals.
exactly.
Right? Like, people still think that
It'd be interesting to get feedback on people who are new to the stock market, and like what they think is going on.
Because I think like Robinhood and Wealthsimple like really generated like more stocks from the average person, right? Because like I honestly I feel like starting up a stock portfolio before Wealthsimple or Robinhood was kind of difficult, bro. Like you kind of need to do some research, and like you would ask people around. Most people won't even fucking know. Right. So I think we can definitely make like some sort of poll. Like I don't know if you want
a Twitter poll.
Yeah, we can do like a Twitter poll. Yeah, follow us on Twitter. Like we'll probably do it on like one of our independent pages and stuff, and then follow all of us so you know which one we put on.
So moving on. So like, as we talked about this with time horizons, right?
Yeah.
When you recommend a stock to somebody, like I learned this firsthand, and so I don't recommend stocks anymore. You don't know what that person's time horizon is. Only they know what their time horizon is. And if you recommend a stock, right, and it could be a good buy today, right? That's to you in your personal situation. It could be a good buy today because your time horizon is much longer. My time horizon could be 10 years from now. I can't be telling all my followers, hey, buy this stock. I'm a genius.
Exactly.
Right? Like, that's the recipe for disaster. Like, I see that all the time, right? It's like someone else's time horizon could be like 2 years, or they don't even know anything about the stock market. I think I talked about this last time.
I don't think you did. I don't think you went into
I don't think you talked about
this. But everybody is not playing the same game.
You did. I remember him saying that.
And traders, there's traders out there.
And
then there's long-term investors. Two different games. And the traders, they're swinging the stock within the same day. Maybe they hold it for a couple days, a week, most likely in the same day. Exactly. Right? And they're trading off momentum a lot of the time, right? A long-term investor, like they're trying to be in there for the long haul, or people who are brand new have no idea what their time horizon is, and they're not even thinking about it, right? They're not even thinking about their time horizon.
They haven't really even looked at that, right?
Yeah, like you could, like, it goes back, like, just like when I bought Facebook, I didn't know anything last year. I bought Facebook, I bought one share for like, I think it was like $255 USD. And, that stock went down like $7 in a week. And I'm like, it's bullshit, and I'm like, screw this. I can't wait for this stock. Like, I don't know what's going on. I literally knew nothing. It's crazy. Like 1 year ago, I knew nothing. Right. And like, it's a large, it's Facebook or Meta, or whatever you want to call it. It's up $100 right now. Right. And like, it's because my time horizon was literally 24 hours. Like I expected it to go up in 24 hours because it was Facebook.
Yeah.
Right?
You didn't even have a time horizon starting
Yeah.
with. That's what the issue was, right?
Yeah, exactly.
Mhm.
So, basically, a takeaway from psychology of money is that, when long-term investors start taking advice from short-term traders, that's when problems arise, right? So basically, like the solution is literally find out which game you're playing, right? Like obviously, if you're not a trader, then you're an investor, and just find out, can you wait? Are you trying to get your money? Do you have a target that you want to hit in 5 years, or is it 10 years, or is it 20 years? And then that's a good starting point, honestly, right? And then beyond that, we have a bunch of, it's all going to be in the description below, but like there's a bunch of channels where you can learn every day about, the overall market, the trends, what's overvalued, what's undervalued, and, that at the very least, so you can basically beat inflation
and preserve that buying power, right?
Exactly.
The main thing we want to get across is like learn what risk management is, figure out your timeline, where you want to get to, make sure you're looking at the fundamentals, make sure you're looking into the team, the management, and do a lot of the research before you get in.
Yeah.
100%.
And I that goes for like multiple products too. Like I would say even like risk assessment, like some people might be comfortable with like starting a business as a risk, or you can go into stocks, or you can go to real estate. There's different like asset classes that you can get into, which will have its own risk and whatnot, right?
Yeah,
so
everything carries a risk, right?
Yeah. Everything's going to carry a risk at the end of the day. The only thing that's guaranteed is saving your money. All right, you can save your money, but you're also guaranteed to never go anywhere in life. Like you can't really do much saving, especially in this day and age. Like back in the day, saving money was like it's like not prehistoric. It was like an older thing. Yeah, that was before they started.
Inflation wasn't as bad either, too, right?
Maybe not even existent, bro. Because I think Nixon took the dollar off the gold standard, the American dollar off the gold standard, I believe in 1982.
Okay.
If I'm not corrected, or 84. Give me the right dates in the comments section down below. But once he took it off the gold standard, bro, they've been printing money left, right, and center, and especially with the inflationary numbers that are coming out right now, it's underrepresented. Yeah. Right. So even the inflation number they're documenting is unrepresented,
and those are already high.
And it's already high. Yeah. Right. Yeah. So when inflation starts happening, you're losing your money, and then like whatever you're saving your money for to buy. By the time you save up your money to buy like a big ticket item like real estate, for example, by the time you save $100,000 to go buy a house,
it's gonna cost more.
Yeah, it's not gonna be $100,000 anymore. And now the increase is stress test. Right. So
this is just a teaser of the inflation segment we have coming up.
Exactly. This is a little teaser, but like
we don't want to give it all away.
Exactly. Well, that's pretty much like what it is, right? You can't really save money these days, especially with the amount of inflation that's happening right now. You can't. I
want to touch on one thing though, just not getting it twisted here. We don't want anyone to get twisted. Like, obviously saving the money and keeping it in your bank obviously is not going to earn you any money. It's not going to increase your buying power. It's going to diminish your buying power. But what we don't want to get it confused with the fact that you should be putting aside 10% of your income every month. Yeah. And even if you're not investing it right away, allocating it towards that's investment money that you're not going to take for any expenses, and you can keep on adding, piling on, stacking it up until you are educated enough to know where to put that money to get the return you desire to achieve your financial goal.
And that 10%, once again, might seem pretty hectic, but once again, you either reduce your cost of living or you increase your income. Increasing your income, increase your damn income, bro. Like, fuck you trying to be all like cheap and shit for you.
Yeah, like me personally, like I'm a spender.
Because we're in the OVO, like
as you said it, right?
I don't know if I gotta blur that out or not.
I can't be a penny pincher, you know what I mean? I'll minimize like the stupid expenses that are just absolutely unnecessary. But
I'd much rather solve the problem by increasing more income.
I'd rather just work harder.
I'm kind of the same way. Like I'm cheap as fuck when it comes to everything, except for the certain things that I need. I'll get good shit.
The things that I really love, like, and enjoy, like, I'm not gonna cheap out on them.
Exactly.
You know what I'm saying? Like the things that, especially like things that are gonna be like beneficial long term, like I'll give you an example, like during the pandemic, like when I forgot the the lockdown, the Ontario lockdown. I think you can say lockdown.
Yeah, we can say lockdown.
When barbers were closed and whatever, I bought hair clippers, but I didn't cheap out on hair clippers. I bought the high end ones.
Nice. Okay.
And
damn.
it was and it's like it was worth it.
Yeah.
You know what I mean?
There's actually a difference. There's a difference in.
Oh yeah.
Like
I could have bought the Walmart clippers, but I bought the high end.
Like the wall
magic clip and the Andis T liner or something like that.
Yeah. You have the barber. You have like the barber shop. Kid at home, right?
Yeah.
Yo, we're gonna put a link to all this stuff down below just for jokes.
But yeah, so
generate some passive income and shit,
Yeah. So that pretty much wraps up this episode. This part two of our stock market series
introduction.
Yeah. So we kind of covered everything we want to go over here. Just be sure to stay subscribed. Follow podcasts for future episodes.
Yeah.
We're gonna go over the Brian Feroldi checklist and go over in depth. Like I think that'll be a very valuable video podcast because I don't think anyone's other than Brian Feroldi. I don't think anyone's really done that. On YouTube, and I think with our audience, I don't think most of our audience would have even seen that before.
Yeah.
So,
but like, if you guys are watching this, you're gonna love that.
100%. Our content is just only going to get better and better.
Yeah.
That's just our humble opinion.
Yeah. And then, we're also open to suggestions. Like, put your
let
shit
us
down,
know
put
what
your
you like,
thoughts
what you
down
don't like,
in the
whatever
comments.
it is.
If you don't like my bald head, tell me that too.
There's not much we could do about that.
Not really much I could, unless I go to Turkey and shit. But
yeah, so I just want to drop some resources that I personally have looked up during my investment journey that. Whether you're a beginner or advanced, like just YouTube channels / podcasts to subscribe to that you could get value from, right? So we're going to have it all in the description below, but Grizzle Podcast, Brandon Beavis Investing, and Steve Antonioni, as we discussed earlier. What will we be talking about next week, Mr. Vino?
Alrighty, so next week we have our long-awaited cryptocurrency episode.
Oh my gosh! Thank you.
We're gonna start from the beginning, talk a little bit about its inception and when Bitcoin came out and the news and everything.
Satoshi Nakamoto.
Yeah.
Apparently they found out who it was.
They always say that, but I'm pretty sure.
You think it's
Greg? Nobody. Really
I heard some guy
Craig Wright or
won like a lawsuit or something, claiming that he was.
Craig Wright.
I think it's Craig Wright.
I still don't. I think I saw that come up, but I still don't think it was him.
Stay tuned to next week. We will find out.
I'll look into that more for that episode. But we got a lot of gold for that. So, or should I say, we got a lot of Bitcoin for that. So I hope you guys enjoy.
Why don't you guys follow us on our socials? We have many Instagram pages, Twitter pages, all that fun stuff down below. We have all the links for that.
Yeah.
Whatever you like.
And if you got any value from this episode, be sure to share.
Yeah. Share this, man. Share this with don't share it to your boy that wants to he wants to like. Don't share it to your boy that wants to like invest in the stock and then like sell it when it goes low. Share it to your boy that wants to learn more about it.
100%. Share it with your boy or girl who wants to learn to fish.
Yes.
And not just be fed the fish all the time.
Yes,
right?
exactly.
Right. Yeah, man.
Share it with your people who want that generational wealth.
Share it to the mandem. Share it to the mandem. Anyways, guys, make sure you guys do subscribe and hit the bell notification button so you guys know whenever we drop videos, because we like dropping videos.
Oh yeah.
All right, take it easy.
All right, guys.
Peace.